Hello, everyone. It's Richard C. Wilson here at the Family Office Club. I'm here today with Ben Lyons from LYNK Capital. Welcome, Ben.
Hi, great to be here.
Sure. So, Ben, I'm really interested in doing this interview here today. You focus on an area that in 13 years running the Family Office Club, I've only ran into 5 to 7 people who do what you do. So why don't you jump into that and just explain what your firm does?
Yeah, absolutely. So I'm the managing director and founder of LYNK Capital. LYNK Capital is a small private equity fund, and we focus on making first mortgages to the real estate investor and builder that is predominantly purchasing, renovating, and building single-family housing. So we provide first mortgages on residential housing for the disposition or ultimate use of income. So 6 to 18-month term loans, so the money turns, and that's the segment we serve. Traditionally served by the community bank. 2008 kind of moved most of those banks out of that space.
Right. Okay. So I'm sure there's change going on right now in terms of what the going rates are. What's kind of the ballpark rates that you guys get or returns you get on those loans that you do?
Yeah, the base interest rates are typically 8% to 10.5%. Certain criteria drives that, but we deploy leverage. So we're a leveraged fund.
Okay.
So an unlevered result would be somewhere around a 7.5% to 8% coupon, which is really not our target. It's very boring. Depending on the years, so there's 37 years of doing this. So depending on the years and how much leverage you use, I've had years where we've produced 25 to 30% returns on a 5-to-1 leverage. This particular fund is capped at a 2-to-1 leverage. And right now we're sitting at around a 1-to-1. At a 2-to-1 leverage, target return should be 12, 13%.
Right, which is good. That's interesting, but not so exciting that people think you're taking a bunch of risk. Is kind of that 11 to 13% range is kind of the general assumption by investors when they're kind of ignorant of what you're doing at all. They just kind of, sometimes think of how much risk there is perceived by looking at those returns. In my experience, obviously, in your strategy, you've been doing this for 30 years. How many different deals or mortgages have you invested in or closed on?
Yeah, well, my marketing director, when we put this fund together in 2013, we went back and we calculated the number of mortgages, and it looks like I'm running around $6.5 billion in my career of originations in 30 some years. So that's tens of thousands of deals. LYNK Capital is closed on 700, just under 700, 690 some loans for $307 million. We've had about half of that repay. So 150
Congratulations.
million. Yeah, thanks. Actually, that's relatively small. The last 2 firms that we built, same team, in 2012 as an example, we did $1.8 billion in originations.
Wow. Okay. So what's your value add process? Because I'm sure there's some people who try to do this. I've spoken to a half dozen that are mom and pop. They're a one-person team. They have trouble getting past 2 or 3 million of assets under management. I'm sure you've seen those in the industry at industry events. So what's your value add process that's allowing you to drive that up?
Yeah, great question. Historically, this segment of the industry, this segment of the lending industry was served by 2 groups. The small mom and pop private lender who had very limited capital and very unsophisticated process, and the community bank. Community banks' rules have changed drastically with Dodd-Frank 2008. We have an expertise in construction lending and expertise in real estate. So when we're lending money to somebody, we're able to very rapidly evaluate risk and very rapidly able to make a decision. Borrowers that borrow our money are only using our money for a period of time to make more money. So cost of capital, we're not talking about a 30-year mortgage where somebody's got to live with that loan interest rate for a long period of time. What makes this investment so attractive on both sides is that we can very rapidly deploy capital to a builder who's building a property to resell it. And it's, although we get a premium for our money, we can easily allow the builder to justify it's easier to get, it's quicker, We're much more user-friendly than a bank would be. And we give that builder the ability to leverage our capital to scale their business. And
Right.
because of our knowledge of construction and our knowledge of real estate, we give that builder, lenders typically play defense against a borrower. Okay?
Right.
In my book that I wrote, I talk about that a lender typically, and historically, a regulated lender has to play defense against the borrower. And you've got to be able to balance playing defense with helping that borrower use your money to make more money. And
Right.
our value add is that we go into every relationship with, we don't want to lend that money to that builder one time. We want that builder to be a client for 10 years and constantly turn our money over. It allows us to manage risk better. It allows us to get a premium for our money. It allows us to know that client. But if that client's making money because of our knowledge and our ability to help them, everybody wins.
Right. Would you work with somebody in Canada or only the United States?
Well, right now it's only the United States, but it's understanding, markets. So understanding the laws, understanding construction management, understanding real estate. We would consider exploring Canada once we learned what we needed to learn to manage the risk.
Sure. Okay. Well, by chance, I do have a lead for you in Canada on the deal flow side. Someone is looking for a group like yours, but also I have investors who like things that are collateral based and provide income or short duration exposure on debt. Is the experience in your fund such that there's a quarterly dividend, or do you put the money in and then you get it out in 2 years, or is it a 5 to 7 year fund and you're turning that capital over 2.5 times within the fund LYNK? How have you structured that for investors?
Yeah, great question. First of all, we operate very similar to a REIT, where as we take in income, we do distribute the collected revenue every month.
Okay.
So we do produce a dividend every month. It fluctuates, obviously, based on collections. And then there's a 2-year lockup. Actually, we changed that to a 3-year lockup now. So the investor is tied up for 3 years.
Okay.
It's not an evergreen fund. We do typically have a 5-year horizon. We don't like to project out too long in terms of real estate markets. We're tied to residential housing. If you believe residential housing is a good bet, and you believe securing your money in a first lien position is a good bet, then we're the fund for you, because from a defensive position, we have collateral. The odds of you losing principal are relatively low.
Sure.
So we distribute cash each month, and effectively that's how we operate.
How many people are on your team?
We had, going into pre-COVID, we had 21 total people. We service and manage every loan we make.
Okay.
We did furlough about a half a dozen people with COVID.
Sure.
We stopped production, making sure that the effects of unemployment didn't drastically affect residential housing in the Southeast United States, which is where we are predominantly.
Okay. Sure. Yeah. And out of the 700 loans you've done, how many have gone into foreclosure, default, worst case scenarios?
Yeah, absolutely. We've had about 6 foreclosures out of about 700 assets. No investor has lost principal to date. We collect interest, and if there is a loss on a foreclosure asset, then we'll absorb it in the interest we collect. We run about 1 to 2% contractual payment delinquency.
Sure.
And for us, that's more than 60 days. Somebody that is more than 60 days late. But in terms of foreclosures, it's been right at half a dozen.
Right. Okay. Great. So it's only a 1% foreclosure and only a 1 to 2%, 60-day plus past payment due type statistic. That's pretty good.
Yeah, allocation for losses typically in this model, and this is 30 years of information, you normally want to allocate about 1%. Okay. So whatever your yield is, just make sure you put aside 1% and assume you're going to take a loss of 1%.
Okay. Okay, great. Well, let's get back to the planned interview questions here. I'm just curious about those aspects. I think some people listening, are probably curious about those same types of things. A lot of investors right now are just, that are already ultra wealthy and they're worth 10, 15, 20 million are looking for places where their downside risk is limited. And that's kind of like the number one thing they want to focus on in all the conversations with me, it seems. What's the number one due diligence question that somebody should be asking you, even if they never ask you? Like, let's say you sold your firm, you went to go invest in one of your peers. What would be the really sharp due diligence question you'd be asking them?
Yeah, and I don't want to digress, but I wrote a book that I'm willing to
Sure.
give to all of your listeners that answers
Sure.
that in great detail. So this book was actually written for anyone that may want to start their own fund.
Okay.
So this explains that if you're going to invest in the mortgage industry yourself or with someone else, how do I do it safely? So I'm willing to give this book out to your listeners, anyone that contacts me. But effectively,
Great.
you have to know the collateral. At the end of the day, you can underwrite a borrower's ability and willingness to repay. But at the end of the day, does that real estate asset protect your money? And it's the due diligence done to know whether that's true or not. So do you know the asset? Do you know you've got information on the asset? One of the things that makes LYNK Capital very unique is that I don't trust anyone. Just so you know, Ronald Reagan said, trust but verify, but everyone will tell you that Ben Lyons doesn't trust until he verifies. So we built a portal that assumes that nobody should trust me. Now, trust is an interesting thing. What this portal does is this provides complete transparency into every asset we make. So our investors can actually just log in and they can see the loans, the appraisals, the title policies, the credit files, the draw schedules, the construction management process, the payment histories of these borrowers and these assets. So an investor doesn't have to call me and say, well, what are you lending on? They can just go log into the portal and actually see the assets that we have first mortgages on.
Right.
And that's the number one thing that an investor should look at. When I give speeches about why mortgage lending is the greatest thing out there on a risk-adjusted basis, I say to you, would you buy a property worth $500,000 as an investment? And you might say, well, it depends on a lot of the variables. And I'd say, well, if you concluded that it was worth $500,000, would you lend somebody $250,000 as a first lien on it? And would you feel safe? Because what could go wrong with your principal there? What's the worst thing that could happen?
Right. It's a slow, patient, you get the 500K asset. It might take a process, but over time you're covered, right?
Yeah, so on a defensive basis, mortgage lending, as long as it's first mortgage lending at the right loan to value, very, very safe. Anybody that's trying to invest in a defensive strategy at a double-digit return, mortgage lending is as good as it gets.
Right. Okay. What is a $100,000 piece of advice you could leave us with here today? Something that would be just really impactful for someone. It could be something related to real estate investing overall, something you've learned running an investment team, or something related to mortgage investing, since that's where you're 1,000 miles deep on your expertise.
Well, the challenge with me, Richard, is that my core of expertise for 37 years is only centered around real estate and mortgage lending. So the only advice I could give is around my core competency.
Sure.
And that's that they owe it to themselves. Every investor that wants to diversify, that doesn't know much about mortgage lending, owes it to themselves to learn about mortgage lending for their own investment benefit. In terms of asset preservation, we all seem to go out and buy real estate regularly as a way to build wealth, and I'm a strong proponent of that because you get the ability to use the bank's money to leverage acquisition of an asset, and that's obviously how wealth often gets created and accelerated. But mortgage lending is as equally as good. So is that worth $100,000? A free book. If somebody wants to figure out how to make $100,000, here's a free book that'll be worth $100,000.
Great. Yeah. Thank you. And for those just watching or listening along audio only, this has been Ben Lyons, and his last name is spelled Lyons with LYNK Capital, and it's LYNK Capital. Is that right for the spelling of the company name there?
That is correct, yes.
Okay, great. And what's the best way to get in touch with you if somebody does want to get a copy of that book called Be the Bank, or just share deal flow with you or co-invest with you, et cetera?
Yeah, absolutely. Best way, two ways, and both are fine. Email is ben@lynkcapital.com, ben@lynkcapital.com, or just text me, 410-258-3903, or call 410-258-3903. Love talking about it, as you can tell. I'm very passionate about this space. It's mind-blowing to me that more people are not, not invested in mortgages in their retirement or non-retirement accounts.
Right. You consider how many people buy a single family rental or invest in the stock market that has more downside, and so many people are hungry for income right now. I could see where there's a big demand once people are educated on what it is actually that you and your team do there.
Well, I ask some very important questions, Richard, when I'm giving a seminar, and I don't want to give you the whole because we don't have time. But what is the top line of income of most banks in the United States?
I don't know. Fees to their clients? I'm not sure.
Okay, well that's number two. The number one line of income is interest income, right? So all of us have checking and savings accounts. We give it to the bank. What do they do with it? They lend it out.
10 times the rate they're paying you.
And mostly they're lending it on real estate secured assets. So if all the banks in the world can use your money as a primary source of their income, why does the individual not do that as well? Right. When I travel around the country asking 1,000 wealthy people that question, I usually get 5 people who raise their hand and say, I have mortgage interest income in my retirement or non-retirement account. It's mind-blowing to me.
Right. Yeah, it's interesting. Yeah, that's great. Well, I appreciate you being here. Maybe at some point, maybe we'll be doing a webinar or discussion panel that makes sense. But we're happy to have you here as part of the Family Office Club and get to know each other before. I know it's the first time you and I have spoke, so we're just getting to know each other. But I'd like to learn more about what you're doing, and I think I've got a connection for you on the deal flow side with another Family Office Club member. So I'd love to keep in touch and appreciate your time here today.
Yeah, absolutely. We are looking to raise a lot of capital, and we have a lot of capital already on hand. We manage over 100 million right now, but it's certainly not enough. So if any of your listeners want to talk further about opportunities, happy to do so.
Great. Sounds good. Thank you, Ben.
Right. Thank you. Take care.
Take care.